Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. This session is going to be very important for all of you because here we are going to discuss the new directions of the Reserve Bank of India for which the RBI has released the draft. Okay. Now, why these draft directions are important? Because usually we discuss the final directions and not the draft, but here we are discussing the draft because it was quite in news recently. Okay, as well as the final guidelines might be released, maybe released after the phase 1. So that's why you need to have the idea about the idea of this draft directions. You need to know about the novation of the OTC derivatives. So even when the final guidelines come near to the examination, you are not confused that what is the meaning of novation, what is the meaning of OTC derivatives and such. Okay, so these draft directions are very important for the understanding purpose, as it was quite in news, as well as here the topic is a little difficult. Okay, so we will discuss the draft directions so that you have the clarity, and when the final directions come, it is very clear for you and it is very easy for you to follow up. Okay, so we are going to discuss the draft directions on the novation of the OTC derivatives. So what is novation, what is OTC derivatives, how this process happens, which are the two institutions which has been mentioned by the Reserve Bank of India in regards to this novation. So all of this we are going to discuss in today's session. And good morning everyone, thank you for joining the session. Do give me a thumbs up if I am clearly audible and visible. Okay, and now before starting with the draft directions, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so the Reserve Bank of India has recently placed on its website the draft Reserve Bank of India Novation of OTC Derivative Contracts Directions 2025. Okay, the comments on the draft directions have been invited from the banks, from the market participants, from the other stakeholders or the interested parties by August 1, 2025. So by August 1, 2025, the comments have been invited by the Reserve Bank of India, after which the RBI will check the comments and will see that okay, what changes can be brought in such, and then the final guidelines will be released. So it might be released at the end of August 2025 or in the starting of the September and such, or maybe later also. So here you have to understand that what are the draft guidelines that have been released, as well as what is this novation, what is this OTC derivative contracts and such. Okay, so I have brought an easy example for you to understand. So first of all, let's understand the OTC derivatives. Okay, let's say there is exchanges, there is National Stock Exchange, Bombay Stock Exchange, there are multiple exchanges in our country. Okay, then here let's say that you want to come, let's say you have USD 5,000, or let's say you are thinking that after 6 months you are an exporter, ABC, you are an exporter company, that is exporter ABC. So after 6 months you are going to receive US dollars 5,000. Okay, after 6 months from your trade, let's say you are selling wheat, or let's say you are selling toys. So from the sale that you are going to do, or from the exports that you are going to do, so from that sale you are going to get $5,000 after 6 months. Now you are thinking that okay, I have to convert these dollars into rupees, but seeing the current situation of the US policies, the tariff war that the US is initiating again and again, the US dollars is weakening, the dollar is depreciating, or the dollar is starting to weaken, and the rupee is starting to appreciate. The rupee is starting to appreciate in some particular months. So you are afraid that what if the rupee appreciate, and let's say for my $1 currently I am getting 85 rupees, but if the rupee appreciates, I will get less rupees. I will get less rupees for $1. Let's say I will only get 80 rupees for $1. So I will make 5 rupee loss on each of the dollar. So this is a little like the export company, that is export company ABC, is going to get dollars 5,000 after 6 months, and the export company is afraid that if the dollar depreciate and the rupee appreciate, if the rupee appreciate, then they are going to get less rupees for their dollars. So export company wants to come into a contract, okay, so that the export company do not lose when the rupee appreciate in the coming months. So let's say the export company wants to come into the contract where the export company ABC wants to sell its $5,000, and the export company wants 83 rupees for each dollar, dollar. Okay, and after 6 months, that is in January 2026, let's say in January 2026, the export company wants to come into this, like in January 2026, the export company wants to sell $5,000 at $1 equal to 83 rupees. And 6 months, like after 6 months, that is January 2026, this trade will be settled. Okay. Now here in the exchanges, there is future contracts. There are futures. In the futures, they are the standardized contracts. They are the standardized contracts. They are not personalized. So let's say there is a future contract that is, you can sell $10,000 for $1 is equal to 83.50. Okay, and this contract is of 3 months, or this contract can be of 1 year. Now, do you think that this export company ABC can have the future contract, can do the future contract, or can take this future contract of selling $10,000? Yes or no? So this export company ABC, now the futures are standardized contracts. They cannot be changed. There are certain standardized contracts in the exchanges, that is future contracts. They are standardized in nature. Their terms and conditions cannot be changed. So $1 for 83.50 rupees. So that is better than the offer given here, 83 rupees only. Here the exporter will get 83.50 rupees. So that is 50 paisa more. But $10,000 has to be given by the exporter, but the exporter only will get $5,000 to sell. Here 3 months or 1 year category is determined, but the exporter will get the money after 6 months. So this contract is not viable for this exporter, because the exporter first of all will not get $10,000, and second of all do not want to sell in 3 months or 1 year. The exporter wants to sell in 6 months. So exporter will go to the forwards, or exporter will go to the over-the-counter market, that is not the exchanges. So over-the-counter derivative contracts, they are the contracts like the forward contracts. They are the contracts like the forward contracts that are customized in nature. The exporter can customize the terms and condition. Okay, so exporter is saying that I want to sell $5,000 at $1 equal to 83 rupees, and I want to sell it in 6 months, that is by January 2026. Now the other party, let's say party Y, that is a bank Y, is saying, okay, I will purchase the $5,000. I will purchase the $5,000 from you, and I will give you 83 rupees for $1. Okay, so here you can understand that this is the OTC, over the counter trades. Why it happens? Because the futures, they are standardized in nature, and if you want a customized, personalized kind of contract, you will have to go to the OTC trade. You will have to go for the over-the-counter derivative contracts. I hope this is clear. So the futures, they are traded. The future contracts, they are traded in the exchanges, but they are standardized in nature. The forward contracts, they are traded in the OTC market, and they are customized or personalized in nature. Okay, so OTC derivative means a privately negotiated derivative between two counterparties that are not traded on exchanges. Now OTC derivatives, they are not traded on exchanges because they are customized in nature. Okay. Now party ABC is the Indian exporter expecting to receive US dollars 5,000 in 6 months. Party Y is a bank acting as the counterparty, acting as the other party. Now party ABC wants to sell USD 5,000, and the party ABC wants to sell the $1 at 83 rupees. Now the party Y is agreeing to this trade. Okay, so here the contract is there that party, the exporter ABC is saying I want to sell $5,000. The party Y is agreeing that okay, I will buy the $5,000 for $1 equal to 83 rupees, and this trade will happen after 6 months, that is in January 2026. This trade is going to happen after 6 months. So this trade will settle in 6 months. So this contract has happened in July, let's say. So this is the contract. Okay, now what is happening, that they enter an OTC currency forward. So a currency forward has been signed, a contract has been signed where party ABC agrees to sell USD. The exporter ABC or the party ABC has agreed to sell $5,000, and the party Y, that is bank Y, has agreed to buy $5,000 at 83 rupees per dollar. Okay, after 6 months. Now this hedges or this reduces the risk for the party ABC against the rupee appreciation, because if the rupee appreciates, then if the rupee is appreciating right now, let's say $1 is equal to 85 rupees. If rupee appreciates, we have to give less rupees to get $1. That means the exporter will get less rupees to get against the dollars, okay, will get less rupees against the dollar. So this kind of risk the exporter do not want. Now original contract is in between, the original contract is between party ABC and party Y, right? Now what happens that let's say after 2 months the party Y realizes that I do not want dollars now, I want euro, or I want some other country. So party Y has realized that okay, I will not be able to continue with this contract because I do not require the dollars now. So after 2 months the party Y has realized this, I don't want the dollars. So now 4 months is left and the party Y is trying to get out of this contract. So party Y, that is bank Y, will talk to bank Z or the party Z. So the party Y will say that okay, bank Z, you want the dollars, right? So come into this contract, take this contract, and this contract will be in between the party Z and the exporter or the party ABC. Okay, that is again the terms and conditions will be totally same because the party ABC will not agree to other terms and conditions. So the terms and conditions will be same. $1 for 83 rupees, $5,000 will be sold by the party ABC, and this contract will settle in January 2026. Okay, so the party Y is like selling the contract or is getting away, is exiting the contract and is selling this or transferring this contract to the party Z or the bank Z. So this is the process of novation. Okay, so after 2 months party Y decides to transfer this exposure to another bank, that is party Z, perhaps to manage its dollar position because the party Y has already got the dollars and do not want the dollars now. So party Y is transferring its exposure to the party Z, the bank Z. Now the original contract was between the party ABC and party Y. Now the party Y is exiting its position. So a new contract will be signed. A new contract will be signed between party Z and the party ABC. Okay. So a new contract has been signed with same notional rate, settlement date and other things. So the new contract is between party ABC and party Z. So party Y exits completely, no further rights or obligations are there, and now party ABC will settle the trade with party Z after 4 remaining months. So any confusion in the novation process? Novation process just means that one party is exiting the trade by giving the position to the other party. That's the idea of the novation. That's the meaning of the novation. So if we see the definition that is given in the draft directions, the definitions do not change. Okay, so let's understand the definition so that you have the clear idea. So first of all, over-the-counter derivative means a derivative other than those which are traded on the exchanges. So the forwards are traded in the over-the-counter derivative, okay, and shall include those traded on electronic trading platforms. So over-the-counter derivatives, they are traded through the electronic trading platforms, or they are traded directly also, but they are not traded on the exchanges. That's the idea. Over-the-counter derivatives, they are not traded on the exchanges. Now novation means, novation, first of all, there are two counterparties, party ABC and party Y. So they are coming into a contract that we have seen. They are coming into a contract. Now the party Y wants to exit the position and the position is given to this party Z. Now the new contract will be signed between party ABC and party Z. So this is the novation, means the replacement of a market maker. Now here remember that the ABC is the exporter while the Y party is a bank that is giving its position to another bank. So bank or the dealers, they are known as the market makers. Okay, so the market makers are the banks or the dealers or the other financial institutions and such. So novation means the replacement of a market maker with another market maker in the contract that is signed between the two counterparties. Okay, so the derivative contract that is signed between the two counterparties is like the market maker is changing from Y to Z. That is the basic idea. And now who is the transferor? Transferor is the one that is selling the contract or that is exiting the position. So here the bank Y is exiting the position. So transferor in novation means a party to a transaction that proposes to transfer or has transferred by novation to a transferee. Transferee is the other party that is taking, is party Z that is taking the position and that is buying the position. Okay, so that proposes to accept or has accepted a transferor's transfer. So basically the transferor is the one that is exiting the position and the transferee is the one that is taking the position and is getting into the new contract. This is the basic idea. So novation means the replacement of a market maker, the bank or the dealer, with another market maker in the contract that has been signed between the two parties, the party 1 and the party 2. Now here a new contract is signed between the new market maker and between the remaining party. Okay, so this is the whole process of novation. So the transferee becomes the new counterparty. The transferee, that is the one that has got the contract, or that has got the position now. So now this is the new party. So transferor, I hope you have understood the transferor and transferee also. Any confusion in this, in the novation, transferor or transferee? Any confusion in this? Anyone? What is 25 XP where? Clear? Got it? Okay, nice. So transferor, transferee, very easy. Now see, this is the trade that is happening between the parties directly. Now in some trades in the OTC also, there is a central counterparty. Okay, that means there is ABC, let's say, or there is the party F, there is a party H. So when the trade is happening between the two parties, but there is a central counterparty in between, so that kind of trade can also happen through the OTC. Here we have taken the example where there is no central counterparty. Sorry, in this example we have taken no central counterparty, but in some cases in the OTC trades also there can be a central counterparty. Central counterparty means an entity that interposes itself, that comes in between the two counterparties. So basically central counterparty, I hope you know about the central counterparty. So let's say there is a party F, there is a party H. The party F wants to sell, party H wants to buy. Now there is a central counterparty, let's say XYZ, that is interposes itself in between the two parties, because the two parties do not trust each other, and that's why they need a central counterparty to handle the circumstances. And if let's say F rejects to sell, there will be a penalty that will be imposed on the F, and the XYZ, that is the central counterparty, will become the seller for the buyer. If the buyer is rejecting the trade after 2 months, after 3 months, so what will happen, that the XYZ will become the buyer for the seller. So basically the central counterparty takes the responsibility of becoming the buyer for the seller and the seller for the buyer. And if both the parties are trading with each other, in that case also, if the settlement happens, the F will sell the product to the XYZ and the XYZ will sell the product to H. The H is buying the product from XYZ. So this is the idea, that central counterparty interposes itself, becomes the intermediary between F and H, where they both are not directly trading now, they are trading through the XYZ. Okay, so central counterparty means an entity that interposes itself between the two counterparties to contracts traded in one or more financial markets, becoming the buyer to the seller and the seller to the buyer. So buyer to the seller and seller to the buyer. So it becomes the buyer to the seller and the seller to the buyer. This is the idea. And thereby ensuring the performance of open contracts, that the open contracts happen. If any one party says that I do not want to continue with the contract, then the penalty is imposed on that particular party, and the XYZ has the responsibility to close the trade with the other party. This is the idea of the central counterparty. Okay. Now in this case, in many of the OTC contracts, there is no central counterparty, because the exporter and the banks, they trust each other, they are continuing with the trade by themselves. So in many of the cases there is no central counterparty in the OTC trades. Okay, so now coming back to the draft directions, we have understood about the OTC derivatives, we have understood about the process of novation, the transferor that is transferring its position, the transferee that is getting the new positions and such. Okay, now we have discussed that the draft directions have been released. Why there was the requirement of the draft directions? How the novation was happening till now? Were there no rules and guidelines? No. At present, the novation of the OTC derivative, that is one party leaving its position and the other party getting the position. So novation of the OTC derivative contracts is governed by RBI circular dated December 9, 2013. We can understand that the novation process, for this process, the guidelines were very old, and that's why there was the requirement of the new guidelines, because the OTC derivative market is changing a lot since 2013, and since 2013 there were new directions that the RBI has brought for the OTC derivatives. So in light of the changes in the overall regulatory framework for the OTC derivatives, the RBI said that okay, we need to make the changes in the directions for the novation also. So that's why the RBI has brought this draft directions for the novation. Okay, So now this directions or the Reserve Bank of India Novation of OTC Derivative Contracts Directions 2025, for which the draft has been released. This is released in exercise of the powers given to the Reserve Bank of India under section 45W of the Reserve Bank of India Act of 1934. Okay. Now these directions shall be called Reserve Bank of India Novation of OTC Derivative Contracts Directions 2025. Now these directions shall apply to all the OTC derivative transactions, the forward contracts that are getting transacted, the interest rate swap contracts and such, okay, undertaken in terms of the provisions of the governing directions. Okay, so if the OTC contracts are happening under the governing directions, under the directions of the Reserve Bank of India, so the novations directions of the Reserve Bank of India will also apply on such OTC derivative transactions. Now on which particular cases the OTC directions will not be the novation directions will not be applicable. So the directions, the novation directions shall not apply to a novation of an OTC derivative contract undertaken by a central counterparty. So when a central counterparty is engaged or when a central counterparty is present, then you can understand that if F is not doing the trade, then the position of the F is transferred to XYZ. Now this is the basic functioning of the central counterparty. For this a separate contract is not needed, right? So in the case where central counterparty is present, in this case the novation happens because the F is leaving its position, is saying that I do not want to sell now, I do not want to trade now. So F is leaving its position, right? And the XYZ has to take over the position, has to complete the trade and is taking over the position. So in this case the transfer of the position from F to XYZ central counterparty will not come under the novation directions because this is the task of the central counterparty. So basically by a central counterparty, directions shall not apply to a central counterparty for the purpose of effecting settlement of an OTC derivative contract if the central counterparty is completing the contract. In this case, the central counterparty will not follow these novation directions. That is the basic idea. There is no separate contract that is required in this case. Pursuant to a scheme, let's say there is the party Y has done the trade with the exporter ABC. Okay, now party Y is merging with another party, or party Y is, let's say, amalgamated with other party. So now the party Y is remaining a party Y, it is just merging with some other entity, it is just amalgamating with some other entity. So in this case also the novation directions will not follow. Okay, so if there is a demerger that has happened or merger that has happened or amalgamation that has happened, in this case there is no requirement of the novation directions to be followed. So this is the basic idea. Okay, now coming to the next point, that is guidelines and mechanism of undertaking the novation. So eligible market participants may undertake novation of an OTC derivative contract subject to the following directions. So novation can happen if the novation of an OTC derivative contract shall be done with the prior consent to the remaining party. So basically that means that if the party Y is shifting its position to the party Z, permission has to be taken from the party ABC. Party ABC should be aware about it because party ABC trusted the party Y, that's why they came into the contract. But now if the party is changing, the ABC should be aware about it. Can it trust the party Z? Then only it will want to come into contract with the party Z. So party ABC should be aware about this transfer that is happening. Okay. Next is, this is very important point to understand. So transaction, see what happens, let's try to understand this, that when the trade was happening, or when the contract was being signed 2 months before in between the party ABC and the party Z, then at that time the current forward rate was $1 equal to 83 rupees, and that's why this price was taken, $1 at the rate $1 equal to 83 rupees. This was the market rate that was going on for the forward contracts. But now after 2 months, what has happened, that now the current forward rate is $1 equal to 81 rupees. So you can understand that now the forward rate is $1 equal to 81 rupees. So in this case, under contract, party ABC gets 83 rupees per USD as per the forward contract rate that was signed 2 months back. Okay. In market, now the current 4-month forward rate is 81 per USD. So 2 months have passed. Now there are 4 months left for the 6-month settlement to happen or for the 6 months to complete. So 2 months back when the contract was signed, the forward contract rate was 83 per USD. But now after 2 months, the forward contract rate has become 81 per USD. So mark to market value means this is the current fair value of a financial contract based on the prevailing or the current market conditions. So on the basis of the current market conditions, 81 should be the rupees that should be given, 81 rupees should be given for per USD. So you can understand that the contract is being signed for 83 rupees per dollar. But actually the contract should have been current. If now the new contract is becoming, so contract should be 81 rupees per dollar. Party Z wants to give 81 rupees per dollar. If the party Z has to give 83 rupees, the party Z will be making loss of 2 rupees, right? Loss of 2 rupees on per dollar, Is it understandable? Is this understandable? Because current rate is 81 rupees, not 83 rupees. And if party Z agrees to give 83 rupees, party Z is making the loss of 2 rupees per dollar. So basically, the mark to market value is 81 rupees multiplied by 5,000, that is 4,05,000. So party Z wants to give 4,05,000 because that is the current rate at which the forward contract should have been signed. Now this is the rate that has been actually in the contract, that is 83 multiplied by 5,000, that is 4,15,000. So basically party Z will have to give 2 rupees extra on each of the dollar, that is $5,000. So that means party Z will have to give 10,000 extra to the party ABC. Party Z will say, why will I do this contract if I have to give 10,000 extra to the party ABC? Okay, why should I give this much of the extra rupees? So this is a liability for bank Y or the party Y. So this is a liability for the party Y because party Y has originally signed this contract. So this is a liability for party Y. That party Y has agreed on 83 rupees. So give this extra rupees, like 2 rupees per dollar. That is 2 rupees per dollar means 2 rupees multiplied by $5,000. So that is 10,000 rupees. So give this extra 10,000 rupees. So party Y will say that, okay, I had signed the earlier contract. So I know that I have made the mistake of like giving more rupees against the dollars. So the party Y will give 10,000 rupees to party Z so that the party Z follows the rules and regulations of the previous contract, because when the rules and regulations of the previous contract are being followed, then only the party Y can leave its position to the party Z. Okay, so party Y will have to give 10,000 rupees to party Z so that when the transaction, so that the party Z agrees for this kind of contract. Okay, so basically party Z will want to have this rules and regulations, that is party Z wants to give rupees 81 for per dollar. But the party Z, if it gets the contract from party Y, it will have to give 83 rupees per dollar to the ABC. So it has to give $2 extra or per dollar. It has to give 2 rupees extra, on per dollar. So that means it has to give 10,000 rupees extra. Okay, so this is actually the liability for bank Y because they are committed to pay rupees 83 when the market forward rate is rupees 81. When novation happens, now bank Y is exiting its position and the bank Z is entering the position on the request of bank Y. So bank Z inherits the obligation to pay rupees 83, which is worse than the current rate of 81, They have to pay 83. That is higher. They have to pay. So now the bank Z must be compensated. Bank Z will say that I will only take this 83 rupees contract when you compensate me, because I have to pay this extra rupees, right? So for taking over, the bank Z should be compensated. So the compensation will be 10,000 rupees. Okay. Now you will say that why not just like, why do this hassle? Why the bank Z is not directly getting into a new contract, with 81 rupees. So actually bank Y is paying a fees to the bank Z also. Extra money is given, extra fees is given, that okay, take my liability, I will give you 1,000 rupees extra or I will give you 2,000 rupees extra. So I hope this is clear that whatever is the current market rate that is going on that basis, the party Y has to compensate the party Z. Or maybe if let's say current rate is more, so vice versa can also happen, because if the party Z is making the profit, so from that a little part has to be given to the party Y also. So basically it is saying the norm is that the transaction shall be undertaken at prevailing market rates. The amount corresponding to the mark-to-market value, that is the amount corresponding to the current fair value of the OTC derivative contract at the prevailing market rate or novation date, shall be exchanged between the transferor and the transferee. That is party Y and the party Z, that are the two banks. They should like settle the compensation that is required so that the new party is on a fair level. The new party is not making the undue loss. Okay. So this is the idea, that when the party Y is transferring its portion to the party Z, then the party Y has to compensate the party Z if there is any loss that is happening because of the party Y that agreed to a contract. Okay, this is the idea. Mukund, because let's say party Y is afraid that in the future more of the rupee will further appreciate maybe, or party Y do not want to give this 4 lakh rupees. Right now it just have to give 10,000 rupees and some additional fees it has to give to the party Y to come to party Z to come out of this whole process. So try to understand that right now the party Y is giving 10,000 rupees to compensate party Z, and let's say party Y is giving a fees of 2,000 rupees to party Z. So in total party Y is giving 12,000 rupees to party Z, and the party Y is coming out of this contract. If the party Y continues with the contract, it will have to give 4 lakh rupees. So party Y do not want to continue with the contract, do not want the dollars and such. Party Y would rather invest this much of the money somewhere else to get more profits maybe. Okay, it depends on the risk appetite of the party Y. It depends on the returns that the party Y is expecting. So party Y do not want to continue with the contract, and to get out of the contract, something has to be paid. Okay, the fees has to be paid and their compensation also has to be paid. This is the idea. Now the parties to the novation shall adhere to the provisions, the new contract that is being signed between the party ABC and the party Z. So the new contract that is being signed, that should follow the governing directions of the Reserve Bank of India. This is the idea. Any confusion, anyone now? Is this clear? So the parties to a novation shall enter into a tripartite agreement wherein the transferee, that is the party Z, steps in the contract to face the remaining party, that is the party ABC, and the transferor, that is the party Y, is stepping out. So party Y is stepping out, party Z is taking the position, and the remaining party is party ABC. Okay, so this is the basic idea. So the original contract has to be replaced with a new contract between the remaining party and the new party. Okay, so between the remaining party and between the transferee, the new contract has to be signed. The previous contract will not follow. This is the idea. Now coming to the next idea, that all the risk. So basically all the risk has been transferred from the party Y to party Z now. If further rupee appreciates, you can understand that the loss will happen to party Z. Let's say the rupee is appreciating. Now it is 75 rupee. $1 equal to 75 rupee. Let's say after 3 months, after 4 months, $1 is 75 rupees and $1 is equal to 83 rupees has to be given. So party Z will make further losses. Okay. So it is the risk that the party Z wants to take, because what if the $1 becomes equal to 89 rupees and it is only giving 83 rupees to get the dollar. So it can make the profits also. That's why it is taking the risk. Okay. So this is the idea. So whatever risk or returns are there are going to the new party, are being transferred to the new party. Okay. Whatever risk is there is being transferred from the party Y to party Z. The transferor and the remaining party are each released from their obligation. That means the party Y and the party ABC, they are not obligated to each other. They do not have any right to each other now, because the party ABC and the party Z have come into a new contract. The older contract has been terminated, has been finished, has been like fired up. So the older contract is not there. Now there is a new contract, and now the party ABC has the right against the party Z, and party Z has the obligation against the party ABC, and vice versa. Now they both are linked. Okay. The transferor and the transferee may agree on the charge or fee between them for the transfer of the trade. So for the transfer of the trade, they can, like, the transferor might pay something to the transferee for taking up the contract. So party Y may pay something to the party Z for taking up the contract. Okay. So this is the idea. Now any relevant document related to the original OTC derivative contract and the underlying exposure shall be transferred. So basic idea is party Y is leaving the contract, so party Y has to give away all the documents to the party Z. This is the basic idea. Okay. Now the fee and their settlement that is happening between party Y and party Z. So if party Y is giving any fee to party Z for taking of the contract, so in this case they may not form the part of the novation agreement. So the settlement that is happening or the fee that is being given in between party Y and party Z, so they may not form the part of the novation agreement, because novation agreement is between ABC and the party Z now, the new novation contract. So in this new novation contract, the fee or charge may not be mentioned, that is in between party Y and party Z. Okay, and party Y has to transfer all the relevant documents to the party Z. This is the idea. Now coming to the last points, so only last 2 points are there. So Fixed Income Money Market and Derivatives Association of India and the Foreign Exchange Dealers Association of India, that is FEDI, as applicable in consultation with the market participants and based on international best practices shall devise the standard agreement for novation, that how the novation is happening, how the new agreement, how is it being signed and such. Okay, so market participants may alternatively use a standard master agreement for novation, so that easily there is a standard agreement through which easily the parties can transfer their position to the other party. Okay, so for the novation there will be a standard agreement that will be formulated by these two institutions. Next is reporting. Now market makers, that is the banks or the primary dealers, as they are regulated by the Reserve Bank of India. So RBI is saying that the market makers, that is the banks or the primary dealers, if they are doing the novation, that bank Y is transferring its position to bank Z. So if the market makers are involved in the novation of an OTC derivative contract, they shall ensure that the details pertaining to the novation are reported to the Trade Repository of Clearing Corporation of India Limited. Very important. So as per the governing directions, as per the main directions of the RBI, the Trade Repository has to be informed or has to be reported in regards to the novation in which primary dealers or banks are involved. Okay, this is the idea. Now this is the first question. Any confusion anyone has in today's session? Tell me. And remember that there is a Perspective 360-degree series that is taken on Monday, Wednesday and Friday. So if you want to know the art of writing the answers, if you want to get the descriptive questions from the current topics, that what kind of descriptive questions can come from Union Budget, from economic survey, and from the current topics what kind of descriptive questions can come, what to write in the answer. So all of this is covered in Perspective 360-degree, where you can know that what you can write in the answers, what kind of questions can come from the current topics. Okay, so this series is very important for all of you to follow for answer writing for the descriptive part of the examination, and this happens on Monday, Wednesday, Friday at 5 PM taken by Jaskaran sir. Okay, so this is the first question. I hope you will be easily able to answer this question. Just you have to tell about the institutions, and this is the second question. Any confusion anyone? Yes, if the party Y is leaving a position, it has the responsibility to transfer his position to party Z. Otherwise, it will be having some penalties. Okay, and this is the novation, right? In the novation, the party Y, if it is leaving its position, it is responsible to transfer its position to party Z or any other party it wants to transfer the position to. It is the responsibility of party Y. Okay, why is it leaving the position now? It has the responsibility to transfer the position. Now this is the second question. I hope you will be easily able to answer this question also. If there is any further queries, any further confusion you have, you can comment down below. Okay, so thank you everyone. Thank you for joining the session, and if you have any confusion, do write in the comment section below. So thank you everyone. Thank you for joining. I hope you enjoyed.